But now let's bring in George Tillis. He's also senior markets correspondent here for us on the network. George, I brought in Amazon for you to kind of dissect here because, you know, if you saw the move on their last earnings, the stock fell pretty sharply, maybe on some investments into AI, but you're starting to see a reacceleration in their big revenue driver or profit driver, and that's AWS. 2 consecutive quarters of a reacceleration in that growth. Is that the key here for Amazon? Because it's sitting just below all-time highs.
Yeah, it is. And I can see why. I mean, if you just consider what's been going on, as you mentioned, just the last couple of quarters, the operating income, which is still the largest percentage of total operating income. It's AWS, by the way, that segment of their business, which still represents less than 20% of their sales. They did resume, operating income growth. It's now about 61% of their total operating income, that division, versus where it was in the past, close to 80%. So we are seeing some resumption of that trend higher in the last 2 quarters. I think if you look at the capital expenditures that the company denoted in the last quarter, they are expected to increase them quite a bit, especially when it comes down to operations, logistics, and warehousing using artificial intelligence as it should. But one of the things I look at when I look at Amazon, I mean, first off, it's a Mag 7 monopoly, and effectively, or a quasi-monopoly, if you want to call it, and effectively they're becoming more profitable, and I think they're becoming more profitable on a consistent basis. And so you're starting to see in Amazon, anytime you see some sell-offs when they have CapEx, and typically in the past, by the way, and correct me if I'm wrong, but you guys may have noticed this, that typically in 1 quarter of the year, Amazon had a huge dip because of capital expenditures, and there was a slight dip this time around, but they bought it back up. And I think it has to do with the fact that they're becoming more consistently profitable over time. And if you look at their operating margin that they posted last quarter, it was actually 300 basis points higher, over 10.7% than the estimate. And the company's profitability from a net income standpoint over the last year, $38 billion on about $590 billion in sales. That's over 6.5%. And if you compare that as an e-commerce business or a commerce business to a company like Walmart, they're about 400 basis points more profitable than Walmart. So e-commerce obviously is a large revenue driver, but effectively Amazon's becoming sort of this multifaceted technology media company, and that's very accretive to margins. And add the AWS proudness in the cloud. This company's most likely going higher considering the profitability profile that they're starting to really pick up on.
George, $100 billion in sales at AWS, now 62% of operating income. That looks like it's on a good path. Can they or should they just keep on working on e-commerce automation, lowering expenses, and let those huge revenues come to the bottom line? Is it as simple as that, George?
Yeah. I think so. I think they can and they are because they can afford to now. Because if you look at the last 8 quarters, there's been a lot of consistency. It used to be there was huge variability. You didn't know if they were free cash flow positive or negative, or if their operating margin was positive or negative. Now, effectively, it's very consistent. And I think that gives you an idea that they can't afford to continue to deploy, CapEx to enhance their technologies, their logistics and operations. Well, at the same time, the media side of their business has been growing. And then you have the mainstay profitable business of AWS. So I think, looking at it, if you just consider looking at Amazon, just the financials, excluding the company itself. So for context purposes, looking at the next year's revenues, they're actually down about $4 billion after the report just a couple weeks ago. But their profit for 2025 actually increased close to 8%. So they were expecting around $5.30. Now it's over $5.70. So my point is that even on slower sales growth than prior estimates, their margin growth is improving by close to 8%. And I think it's very meaningful considering 30% EBITDA growth. It's only trading around 33 times 2025's earnings. So it's cheap based on a growth rate.
Yep. And, you got to take into consideration a lot of that margin improvement is what CEO Andy Jassy's doing. He's cutting, and they cut a lot of workers.
Yep.
They refigured all their delivery
Make it more
mechanisms.
regional.
Yep, more regional too. All right, great stuff. Thanks to George Tilla, senior markets correspondent here, breaking down Amazon for us. Kev,